My dear friends, happy day. This is lecture number 6. This lecture in all probability will be a very short lecture. So we have only 2 questions pending on claim for loss of stock. So I thought of completing that, and in a separate new recording we will have the claim for loss of profit, which will take 3 to 4 lectures only. So where we did all the base work for claim for loss of stock, around 6 lectures now, and that will be around another 4 lectures. That is how we will be planning the completion of this chapter. So almost every chapter, around minimum 6 to 7 classes. Some topics will go to around 12-14 lectures, 14 classes. Anyway, as usual, what we do. So today I have little tiredness, so maybe the real form of energy is not somehow coming. So let's have the recap exercise. Almost coming to the last day of last lecture of the first topic in that first subtopic, claim for loss of stock. So when you have taken insurance policy and we have lost some stock by fire accident, it is our duty to determine the claim. So we should first prove how much stock I had on date of fire by preparing a trading account, in which I will take all information. GP will be determined by sales into GPR as we compute, as we extract information. Once we arrive at GP, then we will arrive at stock on date of fire as balancing figure. Then deduct the salvage value retained, you will get loss of stock, then claim based on the policy amount, based on the average clause mentioning in the policy, then under insurance or not, like that, based on which we will decide what is the amount of claim. Then firefighting expense also should be considered, like that. Basic overall discussion we completed in a sequential manner. Academical purpose, we have 4-step approach. What are the 4 steps? Step number 1, gross profit ratio. Step number 2, stock on date of fire. Step 3, loss of stock. Step 4, claim. As far as gross profit ratio is concerned, gross profit ratio will be given in the question. If it is given, well and good, so happy, take the GPR as it is. Sir, gross profit ratio given, but it was mentioned as on cost, GPR on cost, 30%. Sometimes they will tell GPR, which is gross profit, is 30% above cost. On cost, above cost, both are one and the same. It means the percentage means denominator is 100, that 100 is cost, and the whatever percentage given, say 30 given na, 30 is profit. So cost price 100, profit 30 na, what should be the selling price? Naturally it is more than cost price, the profit, so naturally selling price will be 130. So 30 by 130 on sales, like that, or a simple common sense we have applied there. Similarly, suppose question says 30% on sales, na, it is 30 by 100 on sales. Direct, if the gross profit ratio is given as 30% on sales, it is 30 by 100 on sales. You need not do any plus minus there and all, my dear friends. Suppose the question says 30%, which means it is implied to be understood as it is on sales, like that we discussed them, my dear friends. Then I told you, suppose 2 or more GPR given, of different number of years GPR given, then we will take average GPR. Then we told, suppose GPR not given, we prepare trading account of previous year, in which we take all the information and we arrive this particular GP as balancing figure, express a GP as a percentage of sales. And then in computing that gross profit, if you have abnormal items, such abnormal items shall be eliminated. Effect of such abnormal items shall be eliminated. Like that we told. How to eliminate? We told you there are 2 approaches. One is called restoration approach. Another one is complete elimination approach. So, is these approaches we can refer somewhere? Nowhere you can refer. We have named based on the mathematical adjustment happened, which we can see in different problems of ICA module. We created a theoretical area called restoration adjustment under the complete elimination adjustment. What do you mean by restoration adjustment? Sir, abnormal goods present means it has been valued less than their original price. So in sales, it is less than their original sale price. If it is other activities like opening stock, purchase and closing stock, means it is less than their cost price. Some reduction have already happened. Restoration means treating them as if they are normal goods. So whatever reduction made should be added, is what we told you as restoration approach. Complete elimination approach, what to do, sir? That particular goods should be completely eliminated from the trading account. So when you want to eliminate, it should be from both the sides. But sir, only one side it is abnormal form, and another side is normal form. It's okay. See, when you want to eliminate that particular goods, it should be eliminated from both debit and credit. Sir, is it same amount or different amount? With whatever amount included, that amount should be excluded. So unique statement, our trademark statement, wherever whatever value included, that value excluded from that place. Like that we made one statement, my dear friends. So you can use it at your home also for different purpose. Now coming back to this, we have one more adjustment there, which is what we are going to discuss substantially today, which is the you should consider effect of price level changes from previous year to current year. When the price level changes, selling price, cost price increases, decreases, how to consider the price level changes. Very important discussion that we are going to make out today, for which absolutely no problems you could see in the study module, no discussions is what there in study module, and I find it is not there in many books also. But suddenly we find one question happening in RTP and it comes in examination. So like that, it every chance that it can come in examination. So we don't want to ignore such area. That will be the last area that we are taking. So these are all the aspects we should be understanding about GPR. Then stock on date of hire. When you take stock on date of hire, we prepare a trading account from the beginning of the year in which fire occurred till the date of fire. The trading account is called memorandum trading account. So why do you call memorandum trading account? Sir, because many informations are not actuals, they are estimated information. So we used to tell like some estimated information. On a memorandum basis you prepare. In Tamil we will tell Kuttu Madipa we will prepare. So like that we are preparing a statement called memorandum trading account, in which we will take opening stock, purchase, sales, practically extracted from different sources. Theoretically it is given in the question. Search the question paper. You will be getting the information, gross profit. So closing stock on date of hire is balancing figure. Like that we arrive. Suppose there is abnormality in the current year also. What should I do? Eliminate the abnormality, show it in a separate column or show it in a separate working note. There is no need for separate column, mandatory and all. So don't be like so rigid and all. Be highly flexible mind. I gave you 2-3 alternatives how to present and all. And in that memorandum trading account, so when you take up, suppose last year a abnormality is there, that abnormalities carry forward to current year, opening stock is there. About opening stock, the reality is that some goods has been already having a lower value. Now I would say that you should take only the lower value for the abnormal goods, and accordingly you should be preparing that particular account. But sometimes no, the question will tell that for the purpose of making claim, not on the opening date, for the purpose of making claim, whatever abnormal goods left over is now worth original cost. So remainder of the goods worth original cost. We will tell opening stock also, we will show it at original cost, so that we can establish a relationship between these two figures. Opening stock, in that a part the stock on date of hire we can show. In that opening stock original cost or part if you want to establish. So thereby I don't mind you take at the opening date original cost or reduced value. So but based on the presentation, don't think any wrong understanding and all, my dear friends. This is the way it should be taken. Nothing like that, sir. If you ask me, technically it should be the reduced value, because on that date, if you say opening stock, then on that date it was having reduced value original cost. It was having only reduced value because it is nothing but closing stock of previous year. And in the previous year only the damage have happened. Previous year only stock has been reduced. Opening stock should be at reduced value. But if you take the original cost there, no problem. I don't mind, because anyway that is not the answer. The profit is not the answer. What is the answer? I want stock on date of hire. But based on this, the stock on date of hire will change? No, because stock on date of hire, abnormal goods is only determined separately, independently, not as balancing figure. Only the normal goods column stock on date of hire, you arrive as balancing figure. In normal goods column, any number changes because of that your answer will change. But in abnormal goods column, every number is separately calculated. So further you need not make a presentation only. Abnormal goods column, every number is separately calculated, because there is no rigid rules for that abnormality column. Yes, some goods sold for this much, but remainder of the goods need not be sold for same amount. It may be sold for, so it has been given that some goods sold for 50% of the original cost. Remainder of the goods is estimated to worth 40% of original cost. Like that, every closing stock is having a different base. Sales will have a different base. So I repeat the points. Don't be panic. Sir, and abnormal, I am not understanding. No panic at all. Apply your common sense. Just try to find out what is the value of abnormal goods on the date of hire by the information given in the question. If there is already made a reduction by the company, then the reduced price is what we should take for the remainder of the goods. But the problem says that no, now it's worth original cost, then you should take it original cost. No, question says that no, on the date of claim it is now worth 30% of original cost, then you should apply 30% of original cost. As per the direction of the question, you should take the value of abnormal goods. If no specific direction given, whatever it has been reduced already, that reduced value to be taken. Suppose no reduction have happened, always it is at original cost only is what you should understand. So that way abnormal goods is very, very simple only, no panic at all, my dear friends. Okay. So then we will find out stock on date of hire. Stock on date of hire, aggregate of these two value, that is normal stock as well as abnormal stock. Then salvage value retained. Plenty of discussion already made about salvage value retained. So some portion of the goods saved may be given to insurance company due to several factors. It could have been given to insurance company. So whatever given to them is also to be received from them as claim, but that need not be separately added. So what we should do now, from stock on date of hire, I should deduct salvage value retained. So suppose I saved 50,000, I gave to insurance company 5,000. Apo, what I should do? What is retained? Retained is 45,000. I saved 50,000. I gave to insurance company 5,000. Apo, what I have retained? 45,000. Suppose stock on date of hire was 5 lakhs. Apo, what I should do? 5 lakhs minus 50 or 5,000. 5 lakhs minus 45,000. By doing that, you get 4,55,000 as balance bar. That is what lost by fire. So once again I should add back 5,000. No. So that money you don't want. That is already included in 455. How it is included in 455? I will tell you. Stock on date of hire 5 lakhs. I saved 50. Which means actually I lost by fire how much? I lost by fire only 4,50,000. Then I gave 5,000 insurance company. No, I want money for that also. So thereby it is totally 4,55,000. Like that separately also you can calculate, or straight away 5 lakhs minus salvage value retained. And what was retained? 45,000. So thereby answer you will be getting 4,55,000. Already several example. Recaply example I am giving. That's all. Then firefighting expenses there, that should also be added back, added at this particular step, my dear friends. And then we proceeded for the last claim. Though I worked out 4 different charts, etc., my dear friends, ultimately it's like this part. Average class, one formula we will be applying, that is actually a proportionate claim for the loss we will be providing. That proportion will be applied if 3 conditions are satisfied. What are the 3 conditions? Partial loss. Then insurance policy mentions about application of average class. And you also realize the stock is underinsured. If these 3 conditions are satisfied, you will apply that particular proportionate claim for loss. Like that we understand. All other cases, dash or dash, whichever is less, loss or policy amount, whichever is less. Like that in a simple form you can understand, my dear friends, about this claim. Because if you take the ICE module, based on that I have already given discussion. Complete loss, partial loss, under partial loss, average class applicable, average class not applicable. Like that we have different charts, my dear friends. So actually that has been discussed at that time. In a summarized form, if 3 conditions cumulatively satisfied, you will apply the average class formula, proportionate application. Otherwise always it is policy amount or the loss of stock, whichever is less. Okay. Once that was our discussion, then special issues and all we have already discussed, my dear friends. Sale or return transaction, then goods given to consignee, goods consumed by the proprietor, advertisement purpose, all these things should be eliminated from trading account. Like that and all we discussed it, and we have solved the problems, my dear friends. Now what I will do is that I will just now proceed for the remaining 2 questions. Maybe if it can be completed in 1 hour time, then 1 hour only lecture. This particular 6th lecture you will be feeling extremely happy. So it is 1 hour lecture, already 15 minutes over. So we will see whether we can complete in 45 minutes or so. So if it is extended that much time only this particular lecture. I don't want to take the new topic today itself. Anyway, proceeding further, my dear friends. So you should understand certain aspects here. So when I write a yellow box here, it is a concept, it is a new concept or maybe a small learning that we make for a particular problem. Now we are going to take the 13th question, question number 13. Adukku relevant ana concept is what we are discussing, my dear friends. First of all, we should understand that when we have a insurance policy, say fire insurance policy, risk covers stock available at a particular place. Stock available at a particular place. That is what very important, my dear friends. Why I make this particular points na? See, I have stock worth rupees 10 lakhs na. My stock will be available with my consignee. Some stock is available at some other branch. Some stock is available at the place which I have insured. So in the insurance document, they will also mention this is the stock, quantum of stock, and it is available which place, na, address will be there. In that address fire accident occurred na, that particular stock is covered by the policy, and we will be considering stock on the date of fire. So when we see stock on date of fire, it need not represent the total stock for which I am the owner on that date. When I say stock on the date of fire, it does not mean, so stock on the date of fire represent the stock for which the business entity holds the ownership on the date of fire is how you should be understanding, my dear friends. So stock available at that place on the date of fire, it is not necessary should represent all the stock for which the business entity is the owner. So what happens is that, see, I would have purchased goods from Delhi and the goods is on the way. Goods is on the way. Now at my Chennai office, I have taken a fire insurance policy. There was a fire accident. So to compute the claim and all, can I take the stock which is in transit also as stock on the date of fire? I should not. I should not consider that as stock on the date of fire, even though I am the owner of that stock, because the purchases has been over. I have already paid the money. Only thing is the goods are still in transit. So who is the owner? Seller is the owner or buyer is the owner? So purchase is legally over or not? Yes, it is over. So I am not applying the legal provisions here. I am telling that according to me, the purchases is over. I have already accounted that as purchases. When I have accounted that as purchase, which means it is my stock or that seller's stock, it is my stock. So even though it is my stock, but for the stock on the date of fire, this stock should not be considered because this stock is not available in my shop when the fire accident occurred. Do you understand the point? So thereby only once again I am reinforcing the point that, so when I say stock on that date of fire, it need not represent the total stock for which the entity is the owner. It need not represent. So then what does it represent? It represents only those stock which was physically available in the place where fire accident occurred. I hope you are understanding. So thereby please understand, when I say stock on the date of fire, it is the stock that is physically available on the date of fire at that particular place covered by the insurance. At the particular place covered by the insurance is what you should understand. If I have already sent the goods to my consignee, so if I have sold goods to, sent goods to consignee, who is the owner? Consignor owner or consignee owner? You have learned consignment chapter, no? So consignment transaction means what? Sent by one person to another person who will make sales on behalf of the farmer. Commission agent, but consignee means what? Commission agent. In Bengaluru, I want to sell goods, I would have sent the goods and he will sell the goods, and once he sells, that money will be given to me and I will give commission. It is a basic consignment transaction, correct? So when I have transferred goods to Bengaluru consignee, who is the owner? Consignor owner or consignee owner? Consignor is the owner, consignee is never owner. Consignee, how come, sir? Agent can't become the owner. He is just an agent who represents me to sell the goods. That's all. Who is the owner, consignor or consignee? Consignor. So now what happens? I have transferred goods to consignee. Say goods worth rupees 2 lakhs. Now in my Chennai office, fire accident took place. Now that 2 lakhs also is my stock or not? Is it not my stock? Yes, it is my stock. I am the owner of that stock, but that can't be part of the stock on the date of fire. So even though that stock is also my stock only, but that can't be considered as stock on the date of fire. What is stock on the date of fire? Those stock which is physically available in the shop in which fire accident took place, and that too at the time of fire. Like that we should be understanding. I hope you are following. So thereby fire insurance policy covers the risk covers stock available at a particular place on the date of fire. On the date of fire. Upon stock on date of fire need not represent the total stock for which the insured, that is the business entity, is the owner. It need not represent the total stock for which insured, that is the business entity, is the owner. Then what does it represent? It represent only the stock physically available. It represents only the stock physically available at the place covered by insurance. It represents only the stock of insured physically available at the place covered by the insurance. Place covered by the insurance. That is what we should understand. To understand this concept, we are going to make certain adjustments, my dear friends. So we are going to learn certain adjustments. What are the adjustments? So as I already told you one adjustment. What is that? Sir, I have purchased goods from Delhi. Okay. Invoice raised? Yes. Invoice came to us? Yes. I have already recorded as purchases. So because invoice came, I have already accounted as purchases. But goods have reached some Vizag or somewhere on the way only. Goods is in the transit, my dear friends. But what happens in my books, purchases, it is accounted, correct? Okay. Now, this goods physically available in my place? No. Now, fire accident came. About whether this particular good should be part of stock on date of fire? No. About how do I ensure it is not forming part of stock on date of fire? I can't simply deduct and all. What I will do is that I will straightaway deduct from purchases. I should deduct from purchases, because how do I find out stock on date of fire? It's not something directly computed. It is arrived as balancing figure. Opening stock plus purchases minus closing stock. Minus sales. Then only we will be getting that particular closing stock, that is stock on date of fire. So in that case, whatever goods are there in purchases can have its reflection in the stock on date of fire, correct? So if this particular goods, which is anyway should not be part of stock on date of fire, what we should do? It should be deducted from purchase. If you deduct from purchases, indirectly you are not allowing that goods to be there as part of stock on date of fire. It will not be there in stock on date of fire. Understood? It's a simple statement I am telling. So what is that? Goods purchased, accounted, but goods not received. What we should do? Add a less. it should be deducted. It is already there in purchases, but it should not be there in stock on date of hire. So what I should do? Deduct from purchases. Correct? Sorry. Now what happened? Another situation. See, I ordered goods from Delhi. I ordered goods from Delhi. Goods came to me. Goods delivered. Truck came. Invoice not received. Thereby I have not recorded this as purchases. So now what happens? This goods I have not accounted as dash purchases. It is not accounted as purchases. Invoice not received. See, physical delivery came, but accounting transactions are based on the fundamental documents involved for the transaction. So thereby I have not accounted that as dash purchases, but goods have already received. Now, is it part of stock on date of hire? Yes, it is part of stock on date of hire, but it is not there in purchases. It won't come. No, what I should do? It should be added to purchases. Sir, is it you are telling rectification of error? No. For this chapter, in memorandum trading account, we are making this plus and minus. It is not necessarily the correct accounting, wrong accounting. We are not discussing about what is the system of accounting of that particular entity and all. We are telling this stock was available with us at the time of hire. It should be part of stock on date of hire. How do I include it? By adding to purchases for that particular statement which you are going to present to insurance company. I hope you are following this. Purchases accounted, goods not received. What to be done? Purchases accounted, goods not received. What to be done? Deducted. Purchases not accounted, but goods already received. It should be added. Now imagine a scenario, my dear friends. What happens now? See, invoice received, goods received. Invoice received, goods received. What to be done? Invoice received, goods received. What to be done? Nothing to be done, because goods received, it should be part of stock on date of hire. Something always when I tell, it is not necessarily plus or minus should be the answer. Invoice received, goods received. Goods received, it should be there on stock on date of hire. Invoice received, it is already there in purchases. If it is there in purchases, definitely it will come as stock on date of hire balancing figure. No, you need not do any plus or minus. Automatically it will be reflected as stock on date of hire. I hope you are understanding. Suppose, sir, I ordered for goods, but so for invoice not received, so for goods not received. What I should do? Again nothing. Sir, goods not received. It should not be there in my stock on date of hire. Anyway, it is not accounted as purchases because invoice not received. So it is not accounted as purchases. I need not do anything. So purchase related, I told you 4 combination. What are the 4 combination? Easy da. So goods received, invoice received. What to be done? Nothing. Goods not received, invoice not received. What to be done? Nothing to be done. Goods received, it should be included. But it is not accounted as purchases. What I should do? Add. So, similarly, goods not received, it should not be there. But it is already accounted as purchases, deducted. Like this. If you understand like this, plus or minus will come. So instead, goods included, minus goods excluded. That way you can't learn. That is not the way. I want you to apply a proper common sense understanding to make plus and minus. I hope you are following this. So similarly, let us now take up the sales here. As far as sales is concerned, what happened is that I created a sales invoice to a customer, which means I have accounted dash sales. I have created a sales invoice, means I have accounted sales. But the goods yet to be delivered. Goods still there in my place only. It is yet to be delivered. Sorry. Now listen carefully, my dear friends. You should know one thing. If I have accounted sales, which means I am removing that goods from my trading account. Correct? So it will not appear as stock on date of hire. But the problem is that, is it still with us or still with customer? Still with us. Naturally what we should understand, then that particular sales should be deducted. By you deducting sales, you are including in stock or excluding in stock? Including in stock. Because if it is included in sales, it gets excluded in stock. But since it is not delivered, it is there with us. But you have accounted as sales, no. So thereby I want you to reverse it. So thereby you should deduct the add. Deduct is how you should understand. But some students after this explanation they will ask, sir, whose risk, sir? You created invoices, sir. Whose risk, sir? Then again sale of goods act will come, and whether risk and reward transferred or not transferred, or what is the terms and agreement, all these questions and all will come. So naturally you might think that, sir, it is not our responsibility, customer responsibility here. So like that and all we can tell, my dear friends, the point is it can be customer's responsibility, it can be sometimes entity's responsibility also. So you go to a showroom, you buy a TV, and he is telling that they will deliver the TV tomorrow. You paid money and you came home, and that night only fire accident happened, then that particular person can't tell that, sir, your TV lost in our godown's fire accident, etc. and all. So, but sometimes if the customer was a responsible person to take care of the goods, then he may be responsible. We don't know. Anyway, you need not really complicate things and all. Let us understand for this chapter and how institute is solving the solution. If the goods are physically with us, insurance is applicable. If the goods are physically with us, insurance is applicable. Whether accounted as sales, all these things you did not really look into, my dear friends. I hope you are following. So by sale of goods and knowledge, sir, all these things are. So let us not bring other aspects here, my dear friends. So unless the question doesn't say anything otherwise. So unless any other information provided, we always presume if the goods are physically in my shop, then dash is applicable. The fire insurance, the policy is applicable, is how you should understand. So thereby, so once again, so what did I told you just now? I have created a sales invoice, which means sales in it is accounted, but goods yet to be delivered, goods not delivered. In that case, what I should understand? I should deduct. If I deduct, am I including that as stock or excluding from stock? Including in stock. This is how you should understand, my dear friends. Similarly, what happened is that I have delivered goods to a customer. But yet to create the invoice. Now what happens? So I have accounted sales or I have not accounted sales? I have not accounted as sales. If I have not accounted as sales, what happens? I am telling as if the stock is still there with me. But actually stock is there with me? No, it's already delivered. So what should I do? I should add to sales. So like the common sense, you should be making this plus and minus. Understood? So that way I have given you sales situation also. In sales also I can tell you one more situation. Invoice soon prepared, goods soon delivered. What we should do? Nothing. Invoice soon not prepared, goods soon not delivered. What should I do? Nothing. So that way, if both are positive, both are negative, we need not do anything. But one of the situation positive, negative, we may have to do some plus or minus is what we should understand. I hope you are following. So don't bring sale of goods act and the legal complications here. Who is responsible, sir? You responsible or they responsible, sir? Let us understand, if no other information given, stock available with me, I am responsible. And thereby insurance policy, whatever I have taken, is applicable for that stock also. Whatever goods which are available in that shop in which fire accident took place, for that this insurance policy, whatever I have taken, is applicable or not applicable? It is applicable. So they are not going to verify whether it is their responsibility or my responsibility. Practically yes, but no, at least for academically we will not create that complication. So at the end of the day, what is the concept? The policy covers all the stock physically available at that shop, whether it is accounted as purchase or not accounted as purchase. So if it is not accounted, then you may have to make some adjustments. And if it is accounted but it is already not there with you, you may have to reverse it. So once again, so we will take this purchase and sales adjustment alone, my dear friends. So certain adjustments relating to certain adjustments to illustrate above. So what we should do, imagine my dear friends, goods invoice received, purchase invoice received, but goods not received. Purchase invoice received, which means it is already accounted as purchases. If you already account as purchase, what is it you understand? It will automatically include it in the stock on date of hire. But do you have the stock on date of hire? No. So therefore what I should do? Deduct from purchases. Deduct from purchases. Like this. Again, common sense you should think part. Don't memorize this. Even though I am giving this for item of plus and minus, don't memorize. Just the common sense application, correct? So similarly, my dear friends, so purchase invoice not received, but goods received. Goods received are physically available with us. Above policy should cover that or should not cover? So goods should cover, but invoice not received. So I have not accounted as purchases. So if I not account as purchases, it will not be there in the stock. So what should I do? Add. Like that you should think, right? So added to purchases. Added to purchases. Understood? Okay. So similarly, my dear friends, I don't want to write the other two scenario like no invoice received, goods received. What should I do? Do nothing. Invoice not received, goods not received. What should I do? Do nothing. If you want, you can write that also. I don't want to write that statement. Okay. So proceeding further, my dear friends. So sales invoice made. Prepared, but goods not delivered. Sales invoice prepared means what? We have accounted sales, but goods are still there with us. What should we do? Add to sales, deduct from sales. Because sales invoice prepared, now we have accounted as sales. When it is already accounted, there is one more addition is never possible. But should I deduct or not? I should check. Yes, I should deduct because the goods are still there with me. So that way we should understand goods are not delivered means goods are still with me. So by you deducting from sales, you are including in stock or excluding from stock? Including in stock. Like that you should understand. Super. So similarly, my dear friends, it is sales invoice not prepared, but goods delivered. So what should we do? Add it to sales. That's all. So this is how you should understand, my dear friends. I explained you a concept. Again, these are all based on the problems that had come and that has been tested. Based on that, we are creating this theory. So you don't expect, sir, where can I read this theory in a detailed manner? No theory at all. Actually, I told you that throughout the chapter is common sense. That common sense also we are providing as little bit of theory, but we are not compromising on the common sense thinking. In the sense, the conceptual part thinking, we are doing it. So every problem you may have to apply yourself, but little bit of help I am providing. That's all. Little extra help I am providing. But you should not memorize this formula and all. So you are supposed to apply this plus and minus only by applying your common sense, right? So proceeding further, now we are moving to that particular question, say question number 13. We will complete that and then we will move into the last question, my dear friends. So let us take up this question number 13. On 2nd June 2020, the stock of Mr. Nerup was destroyed by fire. Niruppuda. However, following particulars were furnished from the records saved. Stock on 1/4/19. So before this, please understand, 2nd June 2020. So and the moment I see stock on 1/4/19, immediately I conclude that this particular business is having financial year. So 2nd June 2020 fire accident occurred means what? 2021 is the fire. 2021 is the fire. What is the previous year? 1920 is the previous year. Anyway. So 1/4/19. So 1/4/19 means 1920. So 1920 order opening stock given. Then 1920 order closing stock given. Purchases for 1920. Sales for the year 1920. Purchases for the 2021 till date of hire. Similarly, sales information given. Then the question also states that sales up to 2nd June 2020 includes rupees 75,000 being the goods not dispatched to the customer, but the sales invoice is rupees 75,000. Sales invoice is 75, sales invoice already prepared, but goods yet to be dispatched. Goods yet to be dispatched. Our goods is there with us, but we have accounted as sales. If you account as sales, as if goods is not with us, what we should do? We have accounted this as sales. But by accounting as sales, you are excluding from stock, but goods are still with me. So what should we do? Deduct from sales. Less from sales. Deduct from sales. That is how you should be understanding. Purchases up to 2nd June 2020 includes machinery purchase for 15. Machinery in a straight away deduct part. It is a capital expenditure. Similarly, purchases up to 2nd June 2020 does not include goods worth rupees 30,000 received from suppliers as invoice not received up to the date of hire. So like that given. So purchases up to 2nd June does not include goods worth rupees 30,000 received from suppliers as invoice not received. Okay. So what happened? Goods already received, but invoice not received. Is it covered by policy or not covered by policy? The goods are there with me, no. So it is covered, but it is not there in purchases. If it is not there in purchases, it will not come in stock. We want this to be there in stock. So what we should do? Add to purchases. Like that we should understand. Super. These goods have remained in the godown at the time of fire. Value of stock, there is a full stop there. Then value of stock salvaged from fire amounted to 22,500, and this had been handed over to the insurance company. So we saved 22,500. Be careful. And the 22,500 was handed over to insurance company. So what is the salvage value retained? Zero, nil. Salvage value retained is nil. Is what we should understand. The insurance policy is for rupees 1,20,000 and is subject to average clause. So ascertain the amount of claim for loss of stock. Ascertain the amount of claim for loss of stock is how we should understand. Anyway, proceeding further, my dear friends. We will definitely prepare the trading account of 1920 to find out GPR. First step is GPR, for which we prepare for the year 2019-20. Opening stock, purchases, sales, closing stock. Opening stock 1,35,000. Purchases
6,45,000.
Sales
9 lakhs.
Closing stock, it is given as 1,62,000 at 90% of cost. We already told you if there is undervaluation or overvaluation of total stock. It's not a question of abnormality here. So then it should be brought to the original cost price. So it is 1,62,000 divided by 90% or 90 into 100. So it is 1,80,000. So we get gross profit
3 lakhs.
3 lakhs. We will have gross profit ratio. As far as gross profit ratio is concerned, it is gross profit by sales into 100. So it is 3 lakhs divided by 9 lakhs into 100, which is 33, 1 by 3%, 33.33%, or so this can be simply in a fraction, it is nothing but 1 by 3. That is 3 lakhs by 9 lakhs, that is 1 by 3. So when it is into percentage, into 100. So then only it has become 33.33%. So in a fraction, it is just 1 by 3. We already experienced it. In one of the questions, they are given 33 1 by 3%. So we express that as 1 by 3, correct? Now proceeding further, we have computed gross profit ratio. Proceeding for step 2 to find out stock on date of hire. Stock on date of hire by preparing memorandum trading account. So we prepare memorandum trading account. It's 1/4/2020 to 2nd June 2020. This is the period for which we prepare memorandum trading account. We have opening stock at the original cost of 1,80,000. No sir, at that year beginning reduced price, no. See, that we should not take because it's not a question of normal, abnormal. So for the purpose of claim, if there is undervaluation or overvaluation, we should take always the goods at original cost. So opening stock is 1,80,000. Then we have purchases. Purchase given in the question is
2,25,000.
2,25,000 minus the machinery purchase. MCY, I am writing as machinery purchase. How much is that? 15,000. And then we have already discussed, one sales adjustment, one purchase adjustment. So what happened is that invoice not received, goods received. It should be considered as part of stock. To be part of stock, it should be added to purchases. So unrecorded purchases, unrecorded. How much is the unrecorded purchases? 30,000. So it is 2,40,000. 2,40,000. Then we have sales, my dear friends. What is the sales information? 4,80,000. So when you take up the sales 4,80,000, my dear friends, we understand there is an invoice that has been prepared, which is already there in the sales, but goods not dispatched. So goods not dispatched.
75,000. 4,05,000.
So this should be 4,05,000. 4,05,000. And then we have, in fact, stock on date of hire. We need to consider gross profit also. So here it is 4,05,000 into 1 by 3. 1,35,000. So that we arrive the stock on date of hire as balancing figure. By stock on date of hire as balancing figure, how much is that? 1,50,000. Like this, we compute the stock on date of hire, my dear friends. So we have step number 3, loss of stock is equal to stock on date of hire minus salvage value retained. So which is equal to 1,50,000 minus nil. Even though we saved some 22,500, but we can't take that because it is handed over to insurance company. So that way we find that it is 1,50,000 is the loss of stock. So it becomes a case of complete loss here. It becomes a case of complete loss. Actually, stock destroyed by fire is only 1,27,500. If you ask me, stock destroyed by fire is only 1,27,500 because we saved 22,500. So when we have saved 22,500 out of the stock on the date of fire 1,50,000, actual destroyed by fire is only how much? 1,27,500. Why do you take 1,50,000? Say the problem is because the 22,500 handed out to insurance company. So thereby actually this 1,50,000 consists of two components and you should be knowing. What is that? The real stock destroyed by fire was 1,27,500. Fire knowledge this loss. And though I saved 22,500, that was taken by the insurance company. So I want money for both. Whatever loss I incurred because of fire as well as whatever stock the insurance company have taken out of my salvage value. So thereby we understand it is 1,50,000. It becomes a case of what? A complete loss. Because I had how much? 1,50,000. What I have lost? 1,50,000. Why, sir? But you saved something. No, but that was given to insurance company. It becomes a complete case of, it is a case of complete loss. So thereby, as far as claim is concerned, you need not apply like this average class application and all. So policy amount is rupees
1,20,000.
1,20,000, and as it is resulting into complete loss. Complete loss. The claim is policy amount or loss, whichever is less. That is 1,50,000, 1,20,000 or 1,50,000, whichever is less. Thus, claim equal to 1,20,000. Anyway, this scribblings you may not be understanding. I will read once again. Policy amount is 1,20,000. As it is resulting into complete loss, the claim is policy amount or loss, whichever is less. That is 1,20,000 or 150, whichever is less. Thus, claim is equal to 1,20,000. That way, we have completed, my dear friends, the question number 13 also. We have only one more question, and with that question, this particular topic comes to an end. So around 45 minutes completed. So I told you 1 hour possible, but I don't think it is possible now. We might require another 30 to 45 minutes. Maybe 1.5 hours lecture is what we might be planning. So let's now take up the next segment. But before go to the last question, we have some conceptual discussion there. What are we actually discussing is that considering the effect of price level changes. Considering the effect of price level changes. Okay. My dear friends, I told you we are considering GPR as a basis from previous year, preceding year, and we are presuming that previous year GPR will be the current year GPR, because sir, previous year quantity will be different, current year quantity will be different. So in that case, we find that it could be different GPR. No, GPR will not change based on the quantity. For example, my dear friends, suppose I have cost price 800 per unit. 800 per unit. Profit 200. What is the selling price? Cost 800. Profit is 200. So what do you think the selling price is? 1000. So what is the profit margin? GPR. GPR equal to 200 divided by 1000 into 100. What is this percentage? It comes to 20%. Now this is per unit. Suppose, my dear friends, in year number 1, I have I did this business for 100 units. I did this business for 100 units. 100 units purchase. Then it is 80,000. Then my dear friends, selling price will be how much? It will be 1 lakh. Profit will be 20,000. So when you take the margin, 20,000 divided by 1 lakh into 100, it will be 20%. So the point what I am telling is that GPR doesn't change with quantity. But GPR will change with the price. The GPR will change with price. So, previous year quantity and current year quantity differ, thereby GPR will not change. But previous year prices and current year prices changes, then GPR will change. But you can't use same GPR. So if the question doesn't say anything, unless otherwise mentioned, we have every right to assume that previous year GPR is the current year GPR. There is no change that had happened. Like that we can assume. But if the question specifically states about the price levels and all, what to do is what we are going to discuss now. Understood? So thereby, so far our observation or our inference was GPR from one period to another period will not change due to change in quantity of sales, but will change due to change in price. Now how to consider if price is changed, what do I do, sir? Then you may have to find a different GPR for this. You may have to make some adjustment to the GPR. So how to make the adjustment? Let me demonstrate directly, my dear friends. Okay. So let me take some demonstrations. Example number 1. GPR of previous year, say it is 20%. GPR of previous year is 20%. Selling price of current year has increased by 10%. Previous year GPR how much? 20%. Now you think like, from our academical viewpoint, either this GPR is given in the question, or you may have prepared dash trading account, and in which you have found out GPR as 20%. Correct, Appa? So that way you know previous year GPR is 20, either given in the question or you prepare trading account. But the question also says that current year selling price has increased by 10%, and sales value and all given. Sales value, purchase, everything is given. But they also told you that the current selling price has already increased by 10%. Like this information. Now, question is, what is current year GPR? So we are supposed to apply in the memorandum trading account current year GPR or previous year GPR. In the memorandum trading account, which is prepared for the date, the year of hire, should I apply previous year GPR or current year GPR? Current year GPR. If no other information available, previous year GPR is the current year GPR, we will assume and we will apply. Just because we are applying same GPR, don't think we are applying previous year GPR. We are always applying current year GPR. Now that I know that the price level changes, so thereby it can't be the same previous year GPR. Current year GPR is different. Now what is the different GPR? So previous year GPR 20%, current year selling price increased by 10%. So what is the current year GPR? So you please apply your mind. You use the calculator, do something and arrive at the answer. Write the answer in your notebook. Please write the answer. Let's see whether you are taking it correctly or not. Don't simply stare at the screen. So one or two doing, others are simply staring at the screen is not acceptable. So here listen, my dear friends, some students will give me an answer of 22%. Some students will give me an answer of 30%. So 20 plus 10, 30%. Some students used to give me 18%. Had it been like face to face, I would have got at least 4 or 5 answers now. Anyway, imagine I have received 4 or 5 answers from you now. Maybe all of you are correct also, no problem. So let us now just check how to work out, my dear friends. So what we will do is that, listen my dear friends, so let me take it at previous year and current year. Let the selling price is equal to rupees 100. Selling price is equal to rupees 100. Selling price 100. Gross profit ratio given in the question. This is assumed number. What is assumed number? Selling price is equal to rupees 100 na assumed. Gross profit ratio given. For previous year, what is the gross profit ratio? Given in the question 20%. 20% is given. But what is the gross profit rupees? What is the gross profit rupees? 20% on 100. So you will apply GPR on sales to find out GP. So 20% on 100. What is that amount? It is rupees 20. Rupees 20. Now selling price 100, profit 20 na. What do you think the cost price? 100 rupees selling price, profit is 20 pa. What is the cost price? Cost price should be rupees 80. I hope you understood this. The one number assumed, one number assumed, another one given. Based on this assumed number and given information, I computed remaining two. Understood? Sorry, these are all assumed, we computed. We computed. So 100 rupees no assumed number pa sale price is, let that be rupees 100. GPR given in the question, that how much percentage? 20%. Based on the GP amount 20. 20% into 100, 20 rupees. Assumed, computed, computed. So 100 minus 20, 80. Now listen carefully. For current year, what happened now? In the selling price increased by 10%. Increased by 10%. Now from 100, 10% increase is there. But what is this new selling price you think? New selling price will be rupees 110. Rupees 110. So when I say rupees 110, no, it is not simply adding 10% on 100, 10%. It is 10% of 100 is 10 rupees. So 10 rupees when you add, it is 110. Correct? Sorry. Now I didn't say anything about cost price and all. But you can't presume that selling price increase, cost price also will increase. Not necessary. I want extra margin, so thereby I increase selling price. Doesn't mean I am paying more to my suppliers. So cost price still remains the same in the current year. So if nothing else is mentioned, whatever prices of previous year is the prices of current year, we are assuming no. So thereby, if nothing else is mentioned, cost price remains the same. So what do you think the profit is? Profit is equal to rupees 30. What is the profit percentage? Profit percentage will be 30 divided by 110 into 100. So it comes a very unique percentage, 27.27%. Like this you are getting. It is not 22, it is not 30. So this is how you should be computing. Understood?
Yes, sir.
Okay. Sir, but you might tell, sir, in this information, you are assuming one number and you are doing some working. You are liking 100 rupees, so you are doing it, sir. I like 500 rupees, sir. I will get different percentage. No. No. Let's check. Suppose you like only 500 rupees. No. Previous year, current year, selling price. According to you, how much rupees? 500. You like 500 rupees note or 2000 rupees note? You may want 2000 rupees note, no problem. So selling price rupees 500. What is GPR? GPR given or not given? Given. How much is that? 20%. What is the gross profit? 500 into 20%. Rupees 100. What is the cost price? Cost price is 400. So got earn coming. So current year what happened? This is increased by 10%. Doesn't mean 510. This is what I told you. 10% doesn't mean 10 should be added. 10% of 500 is 50 rupees. About total how much? 550. 50 rupees. 10% of 500, 50 rupees. So 550. Sorry. If cost price remains the same. What is the cost price? 400. What is the profit? 150. What is the ratio? 150 divided by 550 into 100, 27.27%. So you don't take like, sir, 100, 200 doesn't matter. So there is one number assumed and you can proceed. So I have just taught you the unique technique of computing or converting the previous year GPR in terms of current year GPR when the price level changes. Do you understand the concept? Yes. So when the price level changes, how to convert from one GPR into another GPR is what we have just now learned. Shall we proceed further?
Yes, sir.
Okay. So now what we will do is that, okay, I don't know, like maybe I just stop here. The screens for copying and all, I don't know whether I have given today. So just take a few seconds. This is frame number 1 for copying. Stop the video, copy, resume. Frame number 2 for copying. Frame 3 for copying. Okay. This calculation which is given in red to just to demonstrate that quantity will not change the ratio. It is the price level which changes the ratio. So we wrote the inference. And now how to adjust the gross profit ratio from one period to another period? is what I have demonstrated through this example number 1, and in which I assumed one number. So students might feel, sir, you're taking the number what you like the most. I have different number. It's okay, no problem. Any number you take, you won't have any issues. Like that we told. So what I will do, I will take one more example for you to get the confidence level, and apaka sir, I also got the answer. Adhika I will do one problem, and then we will go into the last question. Takkana will complete, and Takkana will complete today's lecture. Usually I will tell in the classroom like, Takkana will complete, Takkana will go. But here Takkana I will complete and Takkana I will go. Okay. So listen carefully. We have one more example. Let's take another example. Example number 2. Gross profit of previous year is 40%. Current year selling price has increased by 10% and cost price has increased by 25%. Ditto, I will not give same problem. Some change should be there, no? Compute current year GPR. Current year GPR. Suppose you should pause the video for some maybe 60 seconds also. Tak you can do. Take calculator working, and you can arrive at the answer. You should be finding out the current year GPR. So previous year GPR you have somehow determined or given the question. Using that information, you can convert the previous year GPR in terms of current year GPR. So that is what I want you to do. Okay. So let me try. So you have tried is what I believe. So we will take current year and previous year. Same thing. Let the selling price equal to rupees 100. GPR given in the question. What? 40%. So what is the gross profit? Rupees 40. What is the cost price? Rupees 60. 100 minus 40, rupees 60. Now selling price increased by what percentage? 10%. So what is the new selling price? 110. Cost price increased by what percentage? 25%. What is the amount of increase? 25%. 15 rupees. So 60 plus 15 rupees 75. So please be very careful, my dear friends. It is not 60 plus 25, 85. So it is 25% of 60 rupees is 15. So 60 plus 15 is 75. So that way we find that gross profit is how much? 35. Gross profit is 35. So we have, my dear friends, gross profit ratio as 35 by 110 into 100.
31.81%.
Okay, so 31.82%. 31.82%, like that we should arrive. So we have learned in a simple manner how to convert one GPR in terms of another GPR if the price level changes. That is what we have learned, and we can apply this in one of the problem, my dear friends. And then with that we are just coming to the conclusion of this particular topic. So, and then 2 questions, okay, I will give the final answer alone. I want you to work out that particular question, right? So let us now go for this question. Question number 16. So just only 1 or 10 minutes over. So already another 20 minutes I think we can complete. I don't know. From the following information, compute the amount of claim under loss of stock policy. Sum assured rupees 6,000. Accounting year is calendar year. Reason for damage due to fire accident on 30th June 2020. Value of salvage stock rupees 5,000. Stock on 1/1/2019 rupees 90,000. Stock on 31st December 2019 rupees 70,000. Purchases during 19 rupees 4 lakhs. Sales during 19 rupees 6 lakhs. Purchases from 1/1/2020 to 30th June 2020 rupees 6 lakhs. Sales from 1/1/2020 to 30th June 2020 rupees 8,80,000. You are informed that in 2020 the cost of purchases and selling prices have increased by 20% and 10% respectively above the levels prevailing in 2019. So this is the information provided, and they have already given compute the amount of claim under loss of stock policy. Please understand the way in which information given, they are following calendar year or financial year. They are following calendar year. And the fire occurred in the year 2020. So what is the previous year? Previous year is year 2019, 1/1/19 to 31/12/19. They have not given the margin, but they have given purchases, sales, opening and closing stock of year 2019. So you should first prepare trading account of 2019 and you will arrive at GPR. But in spite of finding that GPR, we can't use that GPR. Why we can't use the GPR? Because the price level changed. But you should know how to convert that GPR in terms of the current year GPR. And then we proceed for the preparation of memorandum trading account to find out the stock on the date of fire. Once we found out the stock on date of fire, then we will compute loss of stock and then compute the claim. Like that 4-step approach. You can solve. Pause the video. Try the problem for maybe like 5-7 minutes maximum required. You can complete the solution. That is how we expect you to solve the solution. Okay. Please don't stare. Please solve the solution. Take your notebook, calculator. We already applied. So please prepare trading account, GPR, etc. More than 17 years of into teaching, 18th year, and right from 1999 onwards into this commerce field, in fact 97-98 onwards into the commerce field. So many times for the last 22 years I am preparing ledger accounts. Not even one straight line is coming. I don't know why. So you have to bear with me. So it is just like, and nobody is going to measure with protractor whether it's 90 degree or not. So why I am telling this now? I am finding some students always know using, even now at this stage also, intermediate level also, maybe the way in which they brought up discipline, use scale, pencil for ledger accounts, etc. Please don't do this. Sir, you are creating indiscipline in us? No. In the examination, no. You need to save a lot of time, my dear friends. Absolutely, like how your +1 teacher beat you with a wooden scale, which I have experienced. So they will not, it will not happen here. So if you don't use scale, even if it is slightly like it is not straight line, it doesn't matter. So thereby, please my dear friends, in the examination, using scale, pencil, all these things not required. With the pen, just a T account, that's all. That is what required. If you already have a good handwriting, like T is normally straight going to come. So using this sort of approach, even if it is a classroom level, you need not practice. You need to save as much time for your thinking and writing, rather than the artistic work that you provide, or keep on only thinking. All these things shouldn't be there. Whatever you're supposed to do in examination should be right practice at the learning stage. So thereby, the fact what I told is, I am not really concerned with whether it is a straight line or a curvy line, etc. So don't use pencil, pen and all. Don't waste time. Just T enough for a ledger account. Anyway, so I believe that you have completed that much time. I am proceeding for this now. So you would have really shocked some students. After working out this, they really felt so happy from insurance chapter. At the end of this topic, they find easily how I converted GPR from previous year to current year. I really learned, and with that confidence they solved the problem. And the first step, they computed GPR, then they converted it, they prepared memorandum trading account. There lies a shock. What is a shock there? They find negative stock. The memorandum trading account, some of you might have had this negative stock. Sir, you taught me something and I applied it so confidently, I went, but I found that there is some negative stock. What is that, sir? Why is it negative stock? So let's discuss this particular problem, my dear friends. So we have 2019, so opening stock, we have purchases. So what is the opening stock? 90,000. Purchases 4 lakhs. Sales
6 lakhs.
And closing stock 70,000. To gross profit
1,80,000.
Okay. So gross profit 1,80,000, my dear friends. So GPR
1,80,000 by 6 lakhs into 30%.
GPR 30%, but this is of year 2019. We want GPR of 2020. Simple. So let's do that. Let's compute GPR of 2020, where you will have year 2019 and year 2020. Previous year, current year. Very simple, na? Selling price equal to rupees 100. GPR
30%.
GP
30.
cost price
70.
which you all of you would have done this. Then in the current year, my dear friends, what happens? The current year, it is increased by, selling price increased by 10%. So it is rupees 110. And this is increased by 20%. It's 84. So we find the profit is rupees 26. So it is 26 by 110 into 100.
23.64.
Or you can simply mention as 26 by 110. In a fraction, it is only 26 by 110, correct? Profit by selling price, 26 by 110. In terms of percentage, you multiply by 100, you get 23.64. I hope you are following this. Like, any percentage can be a fraction, which can be converted into percentage by multiplying by 100, correct? So 30%, 30 by 100. So that way, you find here it is 26 by 110 is the profit margin. So which can be in terms of percentage 23.6. So either way you can present. You know why? Most of the times I will apply the fraction. You know why? Because the percentage wise I will have some approximation. this is not exactly 23.64%. It is like some 23.636, something like that it goes, and thereby we rounded and approximated to 23.64%, correct? It will be like some 5-6 decimals you have, it is not 2 decimals you got in the calculator. You got 26 by 110 into 100. So when you worked out, you didn't get exactly this. You got 23.64, I don't know, what is that number we got? 6363. So that is how we got 23.64%. So, and that percent when you apply, you know, your accuracy some difference will come, maybe some 10 rupees difference. So suppose answers are in lakhs, 20 rupees difference, 30 rupees difference, like that you will get. So instead, if you want the real accuracy, then it can be multiplied by 26 by 110. On sales, we can apply 26 by 110. If you do that, directly you won't get this particular approximation differences. Understood? Anyway, coming back to this. So we have computed GPR. Up to this, you would have felt happy because you also would have done this. Then we prepare what? Memorandum trading account. So we prepare, we find stock on date of hire. We have stock on date of hire, for which we prepare dash. Memorandum trading account. So this is copying slide number 1. So I won't show later and all. Copying slide number 1. So pause the video, copy this much. Anyway, if you are not done, if you already done, super. This is frame number 2, copying frame number 2. So 26 by 110 or 23.64%. Anyway, you would have got it. So you would have already done it, but I am just ensuring that all of you doing it. Then stock on date of hire, by preparing memorandum trading account, we have opening stock. This is from 1120 to 30th June 2020. So we have opening stock. What is the opening stock, my dear friends? Opening stock is 70,000. It's carry forward from previous year. Purchases 6 lakhs. Oh, this year also 6 lakhs. Last year on 6 lakhs. Last year 4 lakhs. Okay. This year 6 lakhs. And sales
8,80,000.
Yeah, sales 8,80,000. Then we have gross profit, which is 8,80,000 into 26 by 110. You can apply that. You can apply the percentage 23.64 or 26 by 110. 2,08,000 we are getting. 2,08,000 we are getting. 26 by 110. If you apply 23.64%, you will be getting 2,08,000 and odd. You will be getting 23.64%. No, 8,80,000 into 23.64%. When you multiply, you will be getting 23.64%. Some 32 rupees extra will come. So that approximation only I am avoiding by merely multiplying by 26 by 110. So it is not that I don't want you to use 23.64%. You can use that, but some small difference come. So let us avoid it by directly taking fraction. Understood? Now listen. So when I take the closing stock here, stock on date of hire, I find that it is coming as a negative 2,000. See, when you want to have balancing figure here, this side should be greater, no. But here I am finding negative 2,000. How comes the closing stock can be negative? So closing stock can't be negative. Correct, sir. So there is some mistakes here. Is it wrong? Wrong. Sir, what is the mistake here? The mistake I will tell you, my dear friends, there is a hidden implied concept here. Hidden concept, I would say. So this calculation also slightly wrong. That is why I gave you frame for copying, so that if you have copied, I'll be very happy that you are striking it after copying it. So if you are up to this correct, so there is no problem. There is no mistake here, but there is some small, actually not mistake, some extra working to be done. I will tell you what. My dear friends, whatever you did, like converting from previous year GPR into current year GPR is correct. But you should now aware of a fact that in the current year there will be 2 GPR. You should aware of a fact that in the current year there will be 2 GPR. What is that, sir? I don't understand. What is 2 GPR? It is this opening stock, my dear friends. This opening stock was purchased when, pa?
2019.
This was purchased 2019. At what price? 2019 or a price. But even this goods would have been sold in the current year, na? This goods would have been sold in the current year. At which price? Previous year selling price or current year selling price? Current year selling price. Appa adukku oru margin. Then this 6 lakhs was purchased in the current year at current year price. And this also would have been sold at current year selling price. So, no doubt both would have been sold at current year selling price. But the cost price is different. But naturally, margin will be same or different? Different. So, sir, you told this the conversion technique. Is it wrong, sir? No, it's correct. But it is correct fully only if there was no opening stock. Only if there is no opening stock. Because if you are purchased and whatever goods sold in the current year, if it is entirely purchased in the current year, then no problem, your working is correct. But since you have opening stock, which was purchased at old price, sold at new price. Purchased goods, new price purchased, new selling price sold. So these two sales will have two different margin or same margin?
Two different margin.
Same selling price or different selling price?
Same
selling price, but two different margin. So thereby, the first thing I want you to aware of conceptually that there are two margin this year. Which year? 2020. We have two margin. Understood? Margin relating to sale of opening stock. Margin relating to sale of purchased goods. What are the two margin? Margin relating to sale of opening stock. Margin relating to sale of purchased goods. So this year I have sold. Which goods sold? This year purchased goods alone sold? No, I have even sold dash goods. Opening stock. Which was purchased in which year?
2019.
Previous year, 2019. So thereby I am trying in a different angle and all to make you aware that there are two different margins. Margin relating to sale of opening stock, margin relating to sale of purchased goods. Understood?
Yes,
so that is the only small correction you should do. Actually, without striking this only, I can make a small change and I can proceed here, which I don't want to do. Like this or striking is there, na? You should aware that some important things and accordingly later on you will never make that particular mistakes again. Or you should be really, whenever you take this, you remember, oh, two margins, sir told two margin. The margin relating to opening stock, margin relating to purchased goods. So listen carefully, my dear friends. So it is gross profit ratio of 2020, how to find out now? 2019 and 2020. This is previous year and this is current year. And other one more item I write. Opening stock, purchased goods. Like this I prepare. Now listen carefully. Selling price rupees 100. GPR 30%. GP rupees 30. Cost price rupees 70. Now in this year, if it is opening stock will be sold at same old selling price and new selling price. New selling price. So this will become 110, but whose cost remains 70. Understood? So it was sold at 110. In the 2020, we sold 2019 stock at new price 110, but cost price will remain the same cost price of previous year. See, just because of this year purchase price and all increased, I need not pay extra money to my supplier for the goods which I already purchased in previous year. Correct, appa? So whatever goods I am buying this year, I should pay extra money. But whatever goods I already purchased, should I pay extra money? Suddenly petrol price increases, pa. Already yesterday I put petrol, should I pay extra more? So that's all, the same price, so 70 rupees. That is how we understand, my dear friends. So profit is rupees 40, 40 by 110. I don't want to convert to percentage. Let that be 40 by 110. This is the margin. Similarly, on the purchased goods, what happened? Sale price will be 110. Sale price will be 110. So from previous year, whatever goods sold in the current year, extra 10%. So 110. But cost price has increased by 20%, 84. So this becomes 26. And that way it is 26 by 110. Like this, two margin exist. So when you have two margin, should I take average? No, don't take average here. Sir, you only told us, sir, take average and all. That is average of like no 2 or more years GPR given, take average. Now this is 2 GPR in the same year for two different goods. 2 GPR for the same year for two different goods. So I can't take average here. So what I should do now? Now I have 40 by 110, I have 26 by 110. So what I should do to find out gross profit? What is the basic concept of gross profit? Sales into GPR, correct Abba? Sales into GPR. What is the sales of this current year? What is the sale of the year in which I record 8,80,000? But the point is that 8,80,000 has sale of opening stock and sale of purchased goods. Sale of opening stock and sale of purchased goods. Like that, we have two sales in this particular current year. Why we are saying two sales? Because we have two different margin for that particular two sales. So thereby, please understand, my dear friends, we need to find out gross profit now. For that, we need to arrive at, see, if you want to find out gross profit of 2020, it is total sales how much? Sales of 2020 how much? 8,80,000. So first thing what I should do now, this sales I should separate as sale of dash stock, sale of opening stock and sale of purchased goods. And accordingly, I can bifurcate the sales into two. Then what I will do, respective margin will be applied on the respective sales. That margin on that sales. I hope you are following. So that way, in the 8,80,000, single margin you can't apply, and the 8,80,000 should be separated into, split into sale of opening stock and sale of purchased goods. But how do I know, sir? How do I know, sir? Which is sold, which is not sold, or purchase goods, how much sold, how do I know? You need to make some assumption here. It's not again your computations here. In the entire accounting, my dear friends, unless otherwise mentioned, we have an implied assumption. Sir, what is an implied assumption? That implied assumption is called FIFO. What is an implied assumption? FIFO. FIFO means what? First in, first out. Sir, I am not understanding. What are you telling? Very simple, pa. In this year, sales have happened, no? The sale will happen firstly out of which stock, pa? Opening stock or purchased goods. This year, sales happen. Sales happen out of which stock?
Opening stock.
Opening stock, old stock. The normal I will sell. First came goods, first sold. Appo, we understand. So, first we will identify the sale of opening stock. How that is possible? Very simple, pa. What is the opening stock value? Opening stock value is 70,000. So listen carefully, my dear friends. In this margin, if you analyze properly, opening stock, if you analyze, see, cost price 70, sale price how much? 110. Our analysis of margin, we have taken, my dear friends, cost price 70 and sale price how much? 110. Appo, total opening stock how much? 70,000. Total opening stock? 70,000 represents 70. You should find out what is 110. Understood? If cost price is 70, selling price 110. Appo, you should check. If cost price is 70,000, what is sale price? You should find out. So that way we can easily find out sale of opening stock, which is 70,000 representing the base 110 or 70? Yeah, 70. So you should find out what is 110, which comes to how much? 1,10,000. Like that you should find out. So total sales how much? 8,80,000. In that 8,80,000, sale of opening stock is 1,10,000. But you should know what is sale of purchased goods. You should find out what is sale of purchased goods. So in the sale of purchased goods, my dear friends, it's just balancing figure. You can't take like same way. Sir, 84 110. Appa same way 6 lakhs by 84 into 110 na, which means you are assuming entire purchased goods sold, no closing stock. Like that you can't assume, no. So listen carefully, my dear friends. 8,80,000 lakh. First we are assuming what? There is an implied assumption. What is the implied assumption? FIFO. FIFO means what? First in, first out. Which means opening stock fully sold. Then only we sell dash goods. Purchased goods. So that way 1,10,000. So this is balancing figure. So it is 7,70,000. 7,70,000, my dear friends, is the sale of purchased goods. Now we find that, my dear friends, GPR is here it is 40 by 110. Here it is 26 by 110. So GP is equal to 40,000.
1,82,000.
And 7,70,000 into 26 by 110. Like this you multiply, it is 1,82,000. So when you take the total, it is 2,22,000. Current year gross profit, instead of applying total sales into one single margin, we split the sales into two and we apply two different margin. So to do this, first awareness that this year we have how many margin? Two margin. Margin relating to sale of opening stock, margin relating to sale of purchased goods. So why we have two margin? Is it because you are selling at different selling price? No. We are selling at same selling price or different selling price? Same selling price. Then why different margin, sir? Different cost price. Different cost price. That is, opening stock was purchased at previous year cost price and purchased goods purchased at current year cost price. I hope you are following this. So thereby, first of all, a fact, two different margin. Why two different margin? Is it because goods sold at different selling price? No. All the goods are sold at same selling price. Then why different margin? Because of two cost price. Opening stock was purchased at previous year cost price. Current year goods purchased at current year cost price. Understood? So margin is different because of different cost price or different selling price? Different cost price. Like that we understood, and we created a beautiful table to understand the margin, my dear friends. So first we created this structure 100, 30, 70, etc. Then for opening stock alone, selling price increased but dash not increased, cost price not increased. For purchased goods, dash increased, dash increased, selling price increased, cost price increased. Understood? So all these things, second time explanation over, 2,22,000. Now what I will do, I will prepare memorandum trading account. I prepare memorandum trading account, which is again for 1/1/2020 to 30th June 2020. So we have this information to opening stock. How much is the opening stock? 70,000. Two purchases.
6 lakhs.
Buy sales.
8,80,000.
Then to gross profit, refer working note. We can't simply say 8,80,000 to 1 ratio. 8,80,000 split 110 into 1 ratio, 770 into another ratio. Correct? So it is 2,22,000. So we get buy stock on date of hire, which is
12,000.
12,000. This is the stock on date of hire. 12,000. So once that is determined, my dear friends, we will proceed for loss of stock. Stock on date of hire, which is 12,000 minus salvage value 5,000. So it comes to 7,000. Then we have claim. As far as claim is concerned, first complete loss or partial loss? Partial loss. Insurance policy mentions about average loss? Assume, yes. Is it underinsured or overinsured?
Underinsured.
So we understand policy amount is rupees 6,000. So the stock is underinsured. Therefore, claim is equal to loss of stock into
Policy amount divided by stock on date of hire.
Stock on date of hire.
7,000 into.
So which is 7,000 into
6,000 divided by 12,000. 3,500.
3,500. That's all. This is how you should be computing this particular claim, my dear friends. So everything is correct. Whatever initially I taught you, like how to convert one ratio into current another year, that is correct. But when you have opening stock, you should aware that henceforth, whenever you have opening stock, you should aware that there are two margins. Suppose in this question there was no opening stock. There was no opening stock. Then you should apply one margin or two different margins. One margin, which was actually 26 by 110. That you can apply. So that will crystal clear clarity. The clarity should be absolute, my dear friends. That is what we are just trying to do. And also a very complicated, a complex topic we have simplified into different stage of discussion and I provided to you so that you are not missing on the clarity here. It shouldn't be like some blind thing and all. It's slightly a complex area, no doubt about it. But I hope you understood these calculations, right? So now the copying from strike off, you did strike something, no. This is how you found out GPR. For opening stock and purchased goods in the current year, two different margin, how to find out. So you should copy that. So this is the copying slide. Okay. My dear friends, I have an alternative presentation of the same answer here. Now we had difficulty in computing this, assessing that this GPR, 2 GPR, converting GPR, etc. Usually what we will do, we will find out simply GPR of previous year, 30%, and directly we prepare memorandum trading account. Now I am going to teach you, my dear friends, I am going to teach you like how to present alternatively and determine the same answer by using same 30%. I am not going to complicate things by this conversion, etc. This big table what you present now, I am not going to prepare. Then this big working you did and found out 2,22,000, splitting sales into sale of opening stock, sale of purchased goods, then applying this gross profit and finding 2,22,000, I am not going to do. So two big calculations I am going to simply avoid. I am going to directly take this 30% and I am going to arrive at the answer. Can we do that? So let's take an alternative discussion. So the point is, through this problem, I don't want to show how the question can be complicated and all. I'm just telling you how different way of you can arrive at the answers. How the different thought process can result into same answers, my dear friends. So listen carefully. We always have alternatives. So please listen, my dear friends. So that when you try to aware during this learning time and all, you should not feel why you teach these many methods are for us to confuse and all. It's not like that. It is just that to give you confidence that no, even if you think some other way, you will be getting at the same answer is what I am telling. And one more thing is that during learning time, different alternatives you can learn so that your thinking ability, there will be some progression to your thinking, a thought process, etc. For that purpose only we are bringing out the alternatives here. So please listen, my dear friends. After the trading account, we found out GPR 30%. That GPR 30% is previous year GPR or current year GPR? Previous year GPR. Now, what I will do is that I will prepare memorandum trading account straight away. So, I proceed for stock on date of hire by preparing memorandum trading account. Here I open two columns. (2019) column, 2020 column, which is previous year and current year. 2019 column and 2020 column, previous year and current year. Like this, I am taking two columns here. 2020 column will have, it's a simple trading account, 2020 column will have the 2020 information, 2020 information. 2019 column will have dash information. 2020 column will have 2020 information. 2019 column will have 2019 information. No, it's not 2019 information, it is 2020 information at 2019 price. So once again, when you spell out, carefully follow. 2020 column will have 2020 informations. That is 2020 order purchases, 2020 order sales, 2020 is opening stock, etc. 2019 column, what will I have? This is previous year column, no. So which information? Previous year information or current year information? I will have current year information, 2020 information at a previous year price, So what is 2020 column will have? 2020 column will have 2020 information at 2020 price. 2019 column will have what information? 2020 information at 2019 price is how you should understand. Which means both are dash column, both are 2020 column, both are 2020 column, but one represent that 2020 price itself, the other one represent 2019 price is how you should be understanding. If I take sales here, I will write sales one amount, and here when I take, it is which sales I will write? 2020 sales or 19 sales? 20 sales, but 19 price. Quantity will be same, but price will be different. So like that I am going to take, my dear friends. So why you are confusing us? No confusion. So if you just stay calm for 2 minutes, then so much of confusion you had earlier we can simply nullify and we can have a beautiful presentation. And this is what the institute have adopted as answers, and I don't mind you have different the first alternative also you can present. This is only alternative arrive at same answer. They are not going to arrive at different answers. So listen carefully. 2020 will have 2020 information at 20 price. 19 will have 20 information at 19 price. Be very clear with this. Now listen carefully. So let me take up opening stock, purchases, sales, gross profit, closing stock. What is sales of 2020? We already know 8,80,000. 8,80,000. Now the same sales. When I take 2019, I don't search the question for 2019 order sales. I want same sales at 2019 price. How that is possible, sir? Very simple. I know that selling price from this year to this year has increased by how much percentage? 10%. But this 8,80,000 represent 110. So that way you can easily calculate 8,80,000 divided by 110 into 100, which will give you how much? So 8 lakhs sales of 20 or 19? 20, but 19 price. Both represent same quantity or different quantity? Same quantity, but two different price level. Correct, appa? So thereby, you should not check the question and tell, sir, 19 order sales is 6 lakhs, sir. I am not taking 19 order sales. I am taking 20 order sales at 19 price. So how to convert? Sir, already 10% increase. That represent 110. What is 100? No, you should find out. I hope you are following. Sorry. Similarly, what is the purchase of 2020? 6 lakhs. Now, between these 2 years, what is the relationship? Cost to price. Purchase price was increased by how much percentage? 20%. But this represents how much? 120. How to find out? It is 6 lakhs divided by 120 into 100.
5 lakhs.
5 lakhs. 5 lakhs. Similarly, opening stock of 2020 is 70,000. Now, one thing you should know that the 70,000 is already representing 19 price. Because this was purchased in which year? 19 or 20? 19. So, it is already representing 19 price now. Even if you want to convert also, it is already representing 19 price. Correct? People listen carefully. What happens is that I have opening stock, purchases and sales here. So, I can arrive at now GP, because now in 2019 column, all are representing 19 order price. Upon 19 order GPR can I apply or not? The GPR of 19 can be applied if everything is in 19 price. What we told 19 order GPR we can't apply because price increased. Now everything is converted into 19 order price, so we can apply 19 order GPR. What is 19 GPR? 30%. So I will apply 8 lakhs into 30%. It is 8 lakhs into 30%.
2,40,000.
It is 2,40,000. 2,40,000. So now what happens? All information available. So I can arrive closing stock as balancing figure. In which column? 19 column. Though it is 19 column, is it actually 19 information or 20 information? 19 column represent 20 information or 19 information? 20 information at 19 price. Seri, here I am going to arrive closing stock as balancing figure. So if I take closing stock as balancing figure, 5 lakh plus 2 lakh 40, 7 lakh 40 plus 7, 8 lakh 10 minus 8 lakhs. It is 10,000. This 10,000 is balancing figure. First you should understand, and you should also understand this closing stock is closing stock of 2020 at 19 price. This is actually not closing stock of 19. It is closing stock of 2020 at 19 price. Now can I increase the price now?
Yes, sir.
What is the increase? 20% is the cost to price increase, and that way it is 12,000 rupees. 12,000, which is 10,000 represent 100. What is 120 you are finding? Or directly you add 20%. You will be getting 12,000. So we didn't arrive balancing figure. This 10,000 represent closing stock of which year? 19 or illa. It is closing stock of 20 at 19 price. Now you convert this way, you increase it by 20%, it is 12,000.
Yes, sir.
Now as a formality, this much is sufficient. My target was 12,000. That is sufficient. But with formality key, we can balance this 20 column for GP. GP amount 8 lakh 80 plus 12 lakh minus 6 lakh 70. Like that, if you take now, you will be getting 2 lakh 22,000 balancing figure. This is the amount with so much of difficulty we found out here. This 2 lakh 20, breaking sales into sale of opening stock, sale of purchased goods. Like that we did so much of working. No, this working not required now. This working not required. Straight a memorandum trading account. What is that I should do? I should prepare 2 columns. Which 2 columns? Previous year column, current year column. Like that I should have 2 columns. So what is the concept? The current year column will have current year information at current year price. Previous year column will have current year information at previous year price. That is what we have done. and so that in the previous year column I can use dash ratio, previous year GPR, so that closing stock can be balancing figure, which represent current year stock, which this closing stock will represent current year stock at previous year price, so which can be converted. I hope you are following this. So that way, very in a simplified version, straight away, only thing is koncha extra thinking is required, so that two major working, and anyway it is not two. After two working, anyway you prepare memorandum trading account. There anyway you prepare memorandum trading account also. It is like, you know, this working, then you had this GP computation, then you prepare memorandum trading account also. Only thing is, instead we have directly memorandum trading with two columns. Instead of one column, we prepare in two columns. We will be getting the same 12,000 rupees. We got the same 12,000. Do you understand?
Yes, sir.
This is another alternative. If you are comfortable, you can follow this. No, sir, and if comfortable, you follow that also. No problem. Did you understand?
Yes, sir.
Pakka?
Yes, sir.
Okay. So that way, we are just teaching you one alternative, my dear friends. This different way. I would recommend this is the practice. This is a much better practice you can do, avoiding all those things, because this is what I have seen in the institute resource. Not there in the study module, the institute resource. That is how it has been presented. So slightly better presentation. So what is the difference between these two? Very simple, pa. And the first approach, the ratio was converted based on the new prices. And the first approach, the ratio was converted based on the new price. 26 by 110, 40 by 110, we converted. Second approach, you be there. Let the price comes to that ratio. And we compute this. That's all. It's something like, no, either you come here or I will come there. That's all. Simple. So just like that only. It's a simple common sense only we have applied here. I hope you are understanding two different methods. Very elaborated we discussed. So this is one. I got one more. Sir, you told 1.5 hours, 1 hour 45 minutes over. Now it is close to 2 hours, sir. Now over. This is another 5 minutes only. Another 5 minutes. So that at least 2 hours now our lecture. Pa. So I will spend just another 5 minutes to explain you another alternative. Sir, you take any hours, sir, but don't give us alternative and confuse us, sir. This is the only problem, pa. To at least some problem we should exhibit, like, you know, what we have learned. So thereby it is like a small show off, you can think, whatever it is. So we'll just present another alternative here, my dear friends. What is that another alternative here to arrive at the same answer? So what I'm going to do is that, imagine I prepare trading account. We got gross profit ratio 30%. And then you prepared one GPR table, no, in that you got 26 by 110. Imagine we require conversion and we apply 26 by 110. So here one change what we are going to do is that memorandum trading account, another alternative. Directly presenting memorandum trading account. You have two opening stock, purchases, sales, closing stock. So here which GPR we are going to use? We are not going to use GPR of previous year. We are not going to use GPR of two GPR of current year. We will use only one single GPR, which is 26 by 110. You computed now 30% converted into 26 by 110. You one computation you did. So that we are going to use here. So what is the opening stock here? 70,000. What is purchases? 6 lakhs. Sales how much? 8,80,000. Closing stock, we want to arrive as balancing figure. Gross profit. Now when we did that, by computing this 26 by 110, and when we prepared this memorandum trading, sir, we already taken this here and we took GP, so we arrived this negative closing stock, sir. It was wrong, no. The point what you should understand, no, in this mistake. You took 8,80,000 to 26 by 110. Here, anyway, this purchased goods margin is correct. 26 by 110 purchased goods margin is correct. Which margin you ignored?
Opening
Stock, margin relating to opening stock. In that completely not ignored, some portion is already considered. Some margin is already considered because on total sales you applied margin. So some margin is considered. Only thing is, listen carefully my dear friends, you consider this stock also as if it is representing current year price. But actually it is not representing current year price. So if it is current year price, what will be the price pa? If this 70,000 which was purchased in previous year, if this year it has to be purchased, what should be the price? 84,000. So what happens now, when you arrive at this 2,08,000, you are telling as if this also purchased for 84,000. As if this also purchased for 84,000. But did you purchase this for 84,000?
No.
It was already purchased for 70,000, which means in that opening stock you have extra profit of 14,000. You have an extra profit of 14,000 from opening stock. How, sir? Once again, by you applying 26 by 110, which is a margin actually relating to current year cost price, current year selling price, current year cost price and current year selling price, which is true for purchases and sales and all correct. But in the opening stock alone was purchased at previous year price. Appo, and the 20% increased price also is a profit margin to you, you should understand. 70,000 20% increase is there, no? That is also profit margin. Why you say profit margin? Because here I am taking as if all the goods are purchased at new cost price. But this 70,000 was purchased at old cost price. Now, differential portions also profit margin you should be knowing. So thereby you have profit when you took it. If at that time if itself, if you are very careful, first it is 8,80,000 into 26 by 110, you got 2,08,000, no? Then additional profit on opening stock, additional profit on opening stock, additional profit on opening stock. How much is that? 70,000 into 20%. What is 70,000 to 20%? This year if I have purchased, I should have paid extra 20%, no? That is what you have considered, but that is actually a profit to us, and you should be understanding. So what is the total profit? If this is 2,22,000, this will be 12,000. Balancing figure. Once again, when you apply 26 by 110, you took the profit as 2,08,000. What was the mistake I told? The mistake was you consider only one margin, you didn't consider two margin. Only thing is, instead of finding the two margin very elaborately like how we did in the first approach, straight away you can tell extra 14,000 profit should be considered. What is the extra profit of 14,000? The additional profit related to opening stock. Opening stock was not purchased at current year cost price. It was purchased at previous year price. And the differential portion profit for the current year. Correct? Yes, see, last year I bought for 5 rupees. And this year, if I have to purchase, it is 7 rupees. Last year I purchased for 5 rupees. This year I have to purchase for 7 rupees. If I have to sell, no, the selling value is 20 rupees. Selling value is 20 rupees. But what I understand now, see, this year I purchased now 20 minus 7 is a profit. But last year purchased goods get 20 minus 5 is the profit, which means the extra profit how much now? 2 rupees is what we are telling. And the extra profit to be accounted. Extra profit is nothing but difference between dash and dash. Previous year cost to price and current year cost to price is the extra profit. Understood? So that is how another alternative, my dear friends. Some books, instead of explaining this, what they will do, straight away they will take it as 84,000. They will take 84,000. And here they will take 2,08,000 as profit. Anyway, effect remains the same and they will arrive at 12,000. Which I don't want to do because the profit is wrong figure, opening stock or wrong figure, I don't want to take it. Actually, whatever you need to consider as an addition here is actually an addition to profits, and you should be knowing. The stock is actually 70,000 only. Understood? So that way an alternative, you can just have this presentation also, my dear friends. So straight away, so different presentation I would recommend, whichever you are convenient, no, you can present, my dear friends. So but some books will show this is 84 and this is 2,08,000. Overall calculation wise it might be same, but actually profit is wrong, opening stock wrong. But whatever you want to add, this as 14,000, you want to convert 84, that 14,000 is not an addition to opening stock, it is an addition to dash profit. You should be knowing. Understood? That way we have these many alternatives, my dear friends, for completing this. This is the effect of this effect of change in price levels. Every issue, every minute issue, potential issues, whatever not covered by the module also we have covered, and this is how all our chapters will be. Every topic, such wide coverage, conceptual clarity, then we will tune ourselves to academical requirement, many solutions of study module, most of the problems from the RTB, everything would be solved in the classroom. Few things I want you to try, so thereby I will give it as gift, etc. That is how we will be taking, my dear friends. Then as I told you previously, my dear friends, see, I have given gift problems. So answer to gift problems, no, answer to gift question, it was question number 8. So question number 8, it is 6,07,500 is the answer. So then we have question number 13, 15. So question number 15. So it is 47027. 47027. So is the final answer. You arrive at the answer. If required, still maybe I can post that solution in the Telegram group and all. But otherwise, this is how the answer for the gift problems. So 16 problems exclusively for the loss of stock. 6 lectures we have taken. So it is close to 15 hours. Maybe today it is 2 hours only. So close to 15 hours we have spent. Another 10 hours or 25 hours insurance claims alone is what we are doing. So almost like every topic very widely will be covering, so that you will, by merely attending the lecture without so much of additional preparations, after this straight away write some 4 or 5 model exams, I will ensure that you are getting a maximum marks in this paper of accounting and advanced accounting, right? So we'll meet in the next lecture for claim for loss of profit. Lot of interesting discussion, some good conceptual as well as interesting discussion we have in loss of profit, that we will take it in the next lecture, my dear friends, right? So thank you, good day, we'll meet in the next lecture.